Hi there, welcome to this Kaplan Masterclass on the basics of foreign exchange risk. My name's Andrew Mower and I'm a tutor at Kaplan Financial. So what we're aiming to do today is to look at three of the main foreign exchange risks. We're going to start by looking at this transaction risk. Now, this is the main one that you'll see in a lot of these exams. So the more financial management type exams really focus on this transaction risk. So we'll start with that and dig into that a little bit and hopefully understand what that means. We're then going to talk about this thing called economic risk, moving on to that. And finally, we'll look at translation risk. With all three of these, what I'm going to do is give a quick overview as to what it's about, what it means, do a little example with some numbers, which hopefully then brings that to life a bit so you can understand it better. And then also we'll think about mitigations of each of these risks. So for each one, we'll think, what is it? Quick example, and then a mitigation or two as well. So hopefully then we've covered off all the main types of the foreign exchange risk that you'll need. Let's start by looking at this main one then. So usually the most examinable of the three, this transaction risk. Now, what this risk is, it's the risk that between agreeing a deal and then settling the deal in the future at some point, the exchange rate changes. So at some point between we agree a deal now, and then, for example, in my little timeline here, I've got in 9 months' time, we actually settle it. There's a risk that the exchange rate moves. So, for example, it might be that a company agrees to buy some machinery today that they're going to need to pay for in 9 months' time. Now, there's a risk that if they're having to pay this in foreign currency, which we will be in these examples, that between now and 9 months' time, the exchange rate moves against us. And as a result, it costs us more than we might have expected. So between agreeing the deal and actually settling it, actually paying that invoice, if the exchange rate moves against us, it might end up costing us quite a bit more money. Now, if we're talking €1,000 or something, then most companies probably aren't going to be too concerned. But this could be really significant amounts of money. This could be hundreds of millions of euros here. So hopefully you appreciate just a small change in exchange rate could cost the company a lot of money here as a result of these foreign exchange movements. Now, don't forget with risk, it does work both ways. And actually, it might be that the exchange rate moves in the company's favor and it works out cheaper for them. But we don't like that uncertainty. We don't like not knowing what's going to happen. So when we talk about risk, we tend to look at it from the sort of the negative perspective, protecting against the worst happening for the company and it costing them a lot more money. So as I said, we'll do a quick example here with some numbers and hopefully bring this to life a little bit. So I'll stick with my example of agreeing a deal now and then having to settle it in 9 months' time. And what I've gone with here is a quick example of a company, a UK-based company, agreeing to buy some machinery in 9 months' time for 10 million euros. So we need to pay 10 million euros in 9 months' time. Now, the exchange rate at the moment is €1.25 per pound. So just made up, but just as a little example, 1.25 at the moment. So if we were to settle today, if we decided, right, we're going to pay for it up front, if we do 10 million divided by 1.25, it would cost us £8 million. So in the UK currency, it would currently cost us £8 million. But that's not happening. That's just what we might expect at the moment. If we were to settle today, that's how much it would cost us, would be £8 million. But we are actually going to be settling in 9 months' time. So that's just sort of like just to show us roughly what we'd expect it to cost, given today's exchange rate of 1.25. Now, if it does, if the exchange rate does move against us then, and in 9 months' time, the exchange rate is now 1.15 euros per pound instead. So the pound has weakened. Now, what that means when we say the pound has weakened, that means you can buy less for your pound now. So whereas on the left over here, a pound was buying you €1.25. Now the pound's weakened, you can buy less with it. It's only buying us €1.15. So it's worked against us in this situation. So if we then do 10 million euros divided by 1.15 instead, if you look, that's now going to cost us 8.7 million pounds. So whereas we're expecting it to cost 8 million if we use today's exchange rate, that cost has now gone up to 8.7 million pounds as a result of that exchange rate moving. So that's an extra 0.7 million, isn't it? That we are now having to to pay. So between the two things, it's an extra £700,000 just because the exchange rate has moved. And that's a lot of money. Yeah, that's a lot of money for a company to take a hit on. So they might not like that risk. They look at that and go, whoa, we're not too sure about this. As I mentioned before, don't forget this could have worked in our favor, actually, if the exchange rate, if the pound had strengthened in this example to something like 1.35, for example, it would have actually cost us less. But we're focusing on the worst case here and thinking what could happen. Now, fortunately, companies might decide that they don't like this risk. There are things that they can do to try to minimize this risk, to try to reduce it. So we'll have a look at a few mitigations now as to ways that they can protect against this exchange rate movement. Firstly, we'll look at some practical solutions. So what the company could say is, we're only ever going to settle in our home currency. So actually, if we're based in pounds in that last example, we're only going to accept pounds and we're only going to pay people in pounds. So that way, all foreign exchange risk has gone. We only take pounds and we only pay people in pounds. And then that way, foreign exchange risk has disappeared. Again, hopefully you realize that from a commercial perspective and a business perspective, that's not very practical, because not everyone's going to trade in pounds. If you go to a foreign company and say, right, I want to buy your machinery, please, but I'll only pay you in pounds, they're not going to be too happy with that. If they're based in Europe and they deal in euros, they're going to want you to pay euros. So you're going to end up restricting trade quite a lot. What you're doing effectively is passing on that foreign exchange risk to the other company. So you're passing it on to someone else, which is obviously not going to be too, they're not going to be too keen on that. So you then got a couple of other things that you could do. You could what we call lead, which is speed up the settlement. So if you think that the rate is currently quite good, you might do this thing called leading, where you settle early, you pay early for your, or you settle early, you pay early for your equipment or whatever it might be. Equally, if you think that the rate's not good at the moment, but it might get better, we might do this thing called lagging. So that's where you slow it down and you say, actually, we're going to hold off. We're going to take the full amount of time, or maybe even push it further if we can, if we think that the rate's going to move in our favor. Now, those two aren't really necessarily mitigations. They're almost guessing what you expect the rate to do. So if you've got an inkling as to what you think the rate's going to be doing, some companies might lead, some companies might lag, but they are based on, they're almost guessing. You're guessing what you think is going to happen to the rate. Something that's quite practical and a nice way to minimize your exchange rate risk as well is to match your inflows with your outflows. So if we've got a load of euros coming in from customers and we need to pay a load of suppliers in euros, let's not keep translating those back in and out of pounds, because that costs money, and that's where the risk comes in. Instead, we'll use those euros to pay the suppliers. So we'll use the money coming in euros to pay out the money we need to in euros. So maybe set up a foreign bank account, and we'll do it that way. We'll match those. We'll sort of use that to pay off, and then maybe we'll just translate it back into the home currency at the end of the year or something instead. So it makes sense if we're receiving euros and paying euros to sort of net those off if we can. So there's some practical solutions. We then see in a lot of, in various qualifications, we see these hedging techniques, and companies could use forwards, which is where you fix a rate in advance. So you just agree a rate in advance that you're going to use in the future. Futures, very, very similar, but they're traded, and therefore they're standardized. They're like little blocks of futures. Got these things called options, which give you the choice as to, you can use this rate if you want to, but you don't have to. So they're like almost an insurance policy. If you want to use this rate, you can, but you don't have to. You have the right, but not the obligation to use a rate. They come with a really expensive premium up front quite often though, so we have to watch those. Or there are these things called money market hedges, where you both borrow and deposit at the same time in two different currencies. And by doing that, you can make sure that everything's set up in advance and you know how much it's going to cost you. So these are all various hedging techniques that you explore in various subjects. So if you want to look at those further, then I'm sure there'll be plenty of material that you can look at on those. Each one of those has its, has a sort of, could do a whole session on its own, I guess. So there's some mitigations. Hopefully that explains transaction risk. As I say, that's sort of the main one of the three. So just wanted to make sure that we've got that sorted. There's then this thing called economic risk. Now, this is much broader, not as specific. What we're looking at here is the risk that by an exchange rate changing, you might lose a bit of your competitive strength. So you might end up losing a little bit of your edge as a result of change in exchange rates. And we saw that quite a lot with companies in the UK after the EU referendum and the value of the pound plummeted. A lot of companies finding it really hard to compete. And as a result of that, we saw a lot of companies actually going into liquidation because of the cost of supplies from Europe coming in. There was quite an interesting case with Unilever where they were trying to pass on the extra costs as a result of the weaker pound. They were trying to pass those on to Tesco's, and Tesco's refused, and they had a big old dispute. And for a day, you couldn't buy any Unilever products, so it was a nightmare. You couldn't buy pot noodles, and you couldn't buy Marmite in Tesco's for a day, which was I'd imagine quite upsetting for a lot of students. But they settled it, and it all came out all right in the end. But yeah, worth having a look. There's a good BBC News article about that, the Unilever and Tesco dispute as a result of the weaker pound. So some companies will struggle as a result of exchange rates changing. Again, let's have a quick look at an example. So if we've got a UK company, this isn't a one-off deal now. This is their general trade, and they're buying these goods in regularly for $5,000 a unit. I've gone with in this little example. So $5,000 per unit from the US. And then what we're going to do is we usually sell them in the UK for this price of £7,000 per unit. So just watch out for that. So we're buying them in from the US for $5,000 per unit, and then we sell them for £7,000 per unit back in the UK. Now, if we take this arbitrary exchange rate of $1.4 per pound, at the moment, these goods are costing us, do $5,000 divided by that rate of 1.4, is costing us £3.6 thousand per unit. So the profit, we sell them for 7, they're costing us 3.6. So we end up with this profit of 3.4K per unit at the moment. So that's what we're expecting now. Now, if in 9 months' time, for example, the rate is now 1.2, so if the rate's changed down to 1.2 instead, the cost of those goods, still $5,000. We've still got the same price that we're paying our suppliers. But just because of this change in exchange rate, look at this cost now, 4.2 grand per unit instead. So whereas on the left there, it was costing us 3.6K per unit, it's now costing us 4.2. And as a result, if we look at our profit here, 2.8K per unit. So again, comparing the two things, so it's costing us an extra, in terms of profit, we're losing 600 quid per unit here, which again could be a lot if we're selling a lot of these. So that profit is being eaten into massively just because of that change in exchange rate, which is going to affect our competitiveness. Our margins have shrunk. Now, one option would be to increase the selling price. That's potentially the way around it, isn't it? To say, right, we're going to have to put up the selling price. But obviously that then has knock-on implications in terms of demand of our products. And like Unilever saw with Tesco, will our end customers actually be willing to pay that? So that can cause all sorts of problems. So it's either you shrink your margins or you put your prices up and maintain the same margin. But that's a tough decision to make quite often. Now, in terms of mitigations, you can't really use traditional hedging. So when I say traditional hedging, I'm talking about the forwards, futures, options that we mentioned earlier, because this is like an ongoing risk. This is all year round. This is affecting the overall business. With transaction risk, it's a nice, discrete, one-off transaction with a set date, everything else, very nice for setting up your forward contracts and so on. With this, because it's ongoing and you're probably trading in loads of different currencies and everything else, unlikely to be able to use that. Maybe one way to do it would be to diversify your currencies. So rather than getting all your supplies in from Europe, for example, let's get some in from America. Let's get some in from Japan. Let's get some in from China. And by using a range of currencies, hopefully it will spread out that risk a bit. So if the pound does weaken against one of those, then we can maybe switch our supply around a little bit. So that might help. We could also use these prudent predictions. So when we're doing our MPVs and our forecasting and everything else, we could just say, let's just be really, really cautious and use like the worst case scenario in terms of exchange rates. So let's look at what the exchange rate might do over the next year, and let's always use the worst case scenario. So that's quite a nice way just to make sure that we've been really cautious with this. But again, not really an answer in terms of how to reduce that risk. The third and final risk I just want to mention in this session is about translation risk, just a quick one. And it's about the change in value of a subsidiary due to changes in exchange rates. So if you've got an overseas subsidiary within your company, it might be that the value of it changes due to exchange rate changes. So if we look at a quick example, we've got this year and then we've got year end next year. Let's imagine that we've got a European subsidiary of a UK company currently worth 50 million euros. Exchange rate is 1.15. So the value of the subsidiary at the moment is 43.5 million. So that's what we'd be presenting that as. That's what we'd be telling people this subsidiary is worth this year end. If the exchange rate then changes and it's actually the euro is now 1.3 euros per pound, for example, again, just a change in exchange rate. If we now do 50 million divided by 1.3, the value of the subsidiary now is 38.5. So again, you can see it's dropped by 5 million, isn't it? So it's a 5 million decrease from last year to this year. And people might look at that and go, wow, this company's lost £5 million. That's cost them 5 million quid as a result of these exchange rate changes. It's not really a cash thing though, is it? This is just a presentation. The company's still worth 50 million euros. You know, the value of that company hasn't actually changed at all. All that's changed is the exchange rate. So this is an accounting risk rather than a cash-based risk. So it's just a presentation thing. We aren't actually losing any money. It's all theoretical. It's just a presentation thing. And as a result, not too many companies would be looking to hedge that. It's just one of those things. But it might be that people look at the company and think, oh, that's dropped in value. And it might just be worth communicating to investors and so on that a lot of that change is due to exchange rates. Right, that's it for this session. So we've been through transaction risk, we've been through economic risk, and we've been through translation risk. Hopefully that gives you a flavor as to what each is and just helps you to understand that a little bit better. And I really hope that this topic goes well for you, and good luck with the rest of your studies.